Let's invite our next guest. The market is still volatile. It's down but not out. N Jayakumar is Managing Director of Prime Securities. He's joining us now. Jakes, hi, good afternoon. Thanks a lot for joining us. Jakes, the kind of moves that we're seeing takes me back to the 2003-4 as well. At that time also we'd seen, when the market was starting that big rally, some of the similar moves, and then there were talks about whether there's going to be some kind of decoupling or not. But you tell us that there's a bit of a debate out here whether we still have a bear market rally or is this a fresh sort of bull market. Of course, Indian context is slightly different, but your views.
Obviously, a lot of this, in hindsight becomes a little more clear. But the way I see this is that, so I call this the Chakravyuh moment in Indian capital markets. You go back to Abhimanyu and in the Mahabharata, the fight that he was having made him get into a formation called the Chakravyuh, and he couldn't get out of it. So the famous thing is, despite being as wonderfully blessed as he was in warfare, but because this last bit hadn't been sort of picked up by him when he was in his mother's womb, if I remember the story right, he couldn't come out of the Chakravyuh. He could only get into it. I think the comparison with this, while it may sound far-fetched, is exactly this, that for a lot of logically correct reasons, the foreign institutions over a period of time have sold off nearly $40-50 billion over the last 6-8 months or more, maybe 8-9 months, barring this last 1 month. That took our indices down to about 15,000. So essentially, logically, as I said, because everybody had a reason, either there were redemptions or they had to move to actually reduce India exposure, or they had to do it with a view to tactically playing other markets like China. These were the three given reasons why, and of course the taper tantrum, etc., leading to low liquidity, lower liquidity in the system. Given all this, we saw the $50-60 billion, which actually has got absorbed through the length and breadth, from Kanyakumari to Kashmir, if you will, through the SIP mechanism. This has got democratized as institutional holding, as individual holding in India. So institutional holding gave way to individual holding. So the foreigners, in a sense, managed to get an exit for 50-55 billion. But guess what? Now, as the dust is settling and some of them want to come in, the first 5 billion has created a move from 15,000 to 17,500 in the Nifty. So I call it the Chakravyuh moment because they've been able to exit, but re-entry on the same parameters, same terms, I think is going to be next to impossible. So we could be entering a period where the Indian markets, where foreign selling has been absorbed and got democratized in terms of holdings as far as Indian individuals are concerned, retail holding across the length and breadth. So we know, for instance, that so many investors sold, let's say, large investors sold 2 crore HDFC or 2 crore Kotak XYZ, but we don't know who the buyers are. And that's got completely splintered and broken and fragmented into multiple household holdings. So I think the next move in the Indian markets will make us significantly more expensive. Already a plus 20% on the Indian markets, minus 20 on the MSCI indicates a certain break of the traditional connection. But I think we could be entering a period where we could get significantly more expensive before the buying frenzy, because as you know, as prices go up, paradoxical to commodities, stock prices and demand for stock actually goes up. So demand follows stock prices rather than the other way around. So I think we are entering a very, very important period where we could be optically more expensive than we are today, make new highs, and yet there'll be a great lust for Indian stocks as foreigners try to return. I think that's the kind of scenario we're entering into right now.
Jayakumar, hi, afternoon. This is largely, so first leg driven by local investors and then foreigners come back. That's basically your thesis here, right? How this plays out?
I think it's a smart early money that is seeing that this play with, let's say, China, etc., hasn't, in a sense, worked out. And therefore, what they're trying to do is to see if they can rebalance their portfolio and coming back here. There are new winners for every rally. So you have, extremely difficult to sort of predict, but more importantly, difficult exposures, very limited exposure stocks that people have had to, which are making new highs. And as money starts coming in, apart from the index stocks, you have this massive movement on the mid and small cap stocks. As basically stock prices go up ultimately as selling disappears. Not so much as a result of buying, but the disappearance of selling. And that's what we are seeing right now. And if you compound that and sort of supplement that with some demand from foreigners, the prices are indicating that on every dip, there is buying that's going on. And the figures and numbers are only indicating exactly that.
You know, this valuation point, Jayakumar, just to press on, I was just looking at trailing 12-month earnings here as compared to, so this is based on MSCI indices. The MSCI India is now trading at over 100% premium to MSCI emerging market valuations. Now, at any other point, you would draw straightforward conclusions, say that, well, things are very expensive here. But I do wonder whether, because China is such a large weight of MSCI emerging markets, some 33% is China, and that is done so poorly, then this measure, it's the widest ever. This premium is the widest ever. But is this a useful measure, and to what degree, in your opinion?
You know, as stocks become more expensive, they enter indices, essentially forcing more passive buying to happen. So this is not that same logic which says that simply because something is more expensive, the added weight or the increasing weight of India in the basket also could be leading to more buying. But I have a different take on this. Everybody is able to see that we are logically overvalued. If you know what I mean. When I say logically, means using empirical metrics based on what we have seen in the past, etc., etc. The reality is everybody is able to see that, and yet markets aren't falling. The reality also is that the exposure that foreigners have had to India has depleted significantly over the last several quarters. So any rebalancing towards this, to even normalize this or move towards a median, essentially means that there's going to be disproportionate buying. So my thesis is that right now, we had a long period, even for instance, markets like Japan in the 80s went to P's that have been not seen. So you could say that if 20 multiple on the index is expensive, 25 is more expensive, but nothing to prevent it from going to 30. All I'm trying to say is that simply because something is expensive doesn't mean that the force of demand at this particular point in time does not overpower that particular metric. So I'm not one to say that we must call a top based on empirical measures, because everybody is able to see the empirical data. Everybody knows that this is not an index that can quote unquote sustain. That's what the traditional logic tells you. Whereas my point here is right now I'm seeing the shift of money, and just on optical fundamentals of the Indian economy, I think there is a lot more money waiting to happen, and that money that's going to come in is not necessarily looking at metrics like multiples for the moment. Within that, by the way, there are in the index, by the way, there's whether it's FMCG or whether it's multi MNC pharma, etc., that are trading at substantially higher multiples than the index average. And there are sectors, which is, for instance, the banking system, or for instance, anything to do with infrastructure, which is trading at significantly lower numbers. So a lot of money could come into sectors like, as I said, infra, sectors like banking, which could make, which also feeds into the positive capex cycle that I'm seeing play out. So just by looking at an index multiple, as they say, the average at the end of the day may have no meaning. The individual components have a lot more sense that you can draw from.
Jake's afternoon. This is Reema here. Wanted to get your thoughts in on the macro data that we got. Q1 GDP was a miss. Economists have brought down the FY23 GDP forecast. Does it have implications for the equity markets in terms of corporate profitability? Perhaps the EPS growth estimates for FY23, FY24?
I think if there's anything in the corporate sector that is a big takeaway, is last few years have seen extremely low capex plans, extremely high deleveraging measures, and corporates as a whole, especially the big corporates, have become significantly deleveraged. And other than maybe one or two large groups, which are heavy-duty groups in terms of market cap, which have taken the leverage. In fact, as somebody said, that you can almost sort of compare the net increase in the banking system credit to just a few groups having borrowed that much. But as a whole, most corporates have deleveraged. And if you take some of the index heavyweights, I think the leverage has never been this low. And more importantly, the capex cycle, if it were to come back, will spur earnings. So I think just seeing what has happened, and especially macro indicators, I don't think has too much to say or too much to do. I think the RBI needs to be lauded for the way they've handled, this entire transition, if you will, of taper tantrum. They're still in the midst of it. And if you take the fact that most PSU banks have actually gone past the phase of, the write-offs being taken, Most of them are at PCRs of 85 and 90%, and therefore write backs is the way forward. Therefore, balance sheets of banks, and especially the big ones, the number two, number three, number four banks are trading at 0.5, 0.6 their book. And as the book starts getting accreted into as a result of write backs, plus their normal regular earnings, and if capex cycle were to even move up a little bit, I think you're talking about stocks that could potentially double and go up to 2.5 times from here over the next 2 years.
Okay, you have been bullish on PSU theme in general, Jakes. Let's talk about a couple of other themes which you have been bullish on. Tata Motors for one. I know you're not too comfortable talking individual stocks, but I brought this up because that's been one of your sort of top bets. But after the recent run that we have seen in some of these auto stocks, do you think it's perhaps played out in entirety?
See, all auto stocks have been pure India plays. Maybe Tata Motors, just not to comment on the stock itself, but is as much, in fact, far more to do with the JLR issues or prospects, if you will, than the Indian thing. So it's not a pure play Indian auto play in that sense. So it's moved a lot less than what some of the others have. And purely from that perspective, I think any improvement in JLR could be big there. I think, in fact, it's moved less than the others. And again, in the past, I've talked about it, but the risk of disclosure, I want to make it. The DVR is as good a powerful play to play on the underlying stock as any. And we've discussed the DVR theme in the past, so I don't want to go into specific stocks really. But the auto stocks, I think, have run up a lot. My own personal feeling is that as a sector, I would be a little cautious on the auto space. I think it may have limited upside left unless there are stocks within the space which have sum of parts metrics where there's divestment theme being talked about or the EV theme being spun out, etc., being talked about. Other than that, and other than those specific stocks, the sector as a whole, I think, is reasonably well valued.
Jayakumar, any other pockets where you are seeing a lot of value right now?
I think the media space has been largely ignored for many years now. And I think there's enough and more consolidation that's happened. That's number one. I think even so media space, there are only 2 or 3 really large players there, and all of them are well consolidated. There's pricing power that exists, and my own assessment is that these assets have never been seeing this low level of a multiple that they're seeing currently. And especially if you take the sum of parts in some of these cases, I think they're extremely compelling at these levels. That's as far as the media is concerned. And the other thing is that the well-integrated metal and steel players, now after a long time, you've normalized in terms of the end product prices coming down and the input prices having come off a lot. So the margins are intact. So for well-integrated players who've dramatically deleveraged, those are the 2 caveats. Well-integrated players and those who have dramatically deleveraged or become near zero debt. Those are the kinds of players that could actually as this capex cycle or as the demand cycle picks up, I think could be hugely benefited.
Okay, Jake, so before we let you go, what to your mind is the biggest risk factor for this market? It's been a very strong market. I mean, so much FI selling. If it was a market of 10 years back, this kind of FI selling would have broken the market's back. Market hardly flinched. I mean, we were down 18% from peak to the recent bottom, and the markets moved on. But what to your mind is the biggest risk?
See, before the risk, I think I want to point out this fact that the exposure of the Indian, should I say, working class or the Indian polity to the equity markets was in low single digits. Maybe that's moved up 1% or 2. And the 1% or 2 has been good enough to absorb $50-60 billion of selling quite comfortably. My assessment is the big risk right now, if you will, is a lot of people are probably not realizing that this is a time when the markets may be going through a one-time re-rating as more and more of this SIP-related money walks in. So there is nothing to say. For instance, if you look at the local sell figures, you're not seeing any large domestic selling. Maybe they're cautious buyers, but so the money flow, as long as it continues, you could be sitting on a dramatic moment where you're actually getting re-rated to a higher multiple before this, before the settling down happens. So the risk right now from an individual perspective is if they're not invested enough in the markets. That's number one. From a market as a whole, the risk point of view is there's very little leverage, whether in terms of individual positions of very large players, I don't think there's so much leverage. Number two, there is no leverage amongst the corporates. So what could actually go wrong is if the capex cycle doesn't take off, which in a sense is getting factored in. As people are buying into some of these stories, they're assuming that capex cycles and the capex investments will follow. If that still turns out to be a wolf, a cry of wolf crying for wolf, as it were, then perhaps the earnings will take a lot more time to catch up. So the markets will be more expensive than they look today. But if the sectors that I'm focusing on, which is things like, as I said, financial services and the capex intensive, I think to me that's the risk that I see, that the capex cycle needs to take off at this point in time.
I like how you put it. Maybe we are in the midst of a one-time re-rating. All right. That's interesting. Jayakumar, thank you very much.
I call it the Chakravyuh moment, and I call it the Chakravyuh moment because I think it draws a lot about preparedness for various things. And I think sometimes people end up becoming more analytical than they need to.
Yeah.
There is a overall feel-good shift that's happening here. And without actually having to thump my chest or bang the table, I think the point that's being made here is that there is a significant risk that individual investors have of not being invested in the markets.
Oh, yeah. I mean, I think we'll get the July mutual fund numbers soon, and we'll see. I mean, the SIP flows have been pretty strong, as Jayakumar pointed out, but discretionary inflows have completely crashed from its all-time highs. They've come off very, very sharply. But the SIP number is still pretty solid, 9,000, 10,000 crores or so. And that's been the bedrock as far as this retail inflow is concerned. Jayakumar, it's always a pleasure. Great to have you with us here. Thank you very much for your time.